All right, let's jump right into this explainer. Today we're taking Agilysys, ticker symbol AGYS, and putting it through the ultimate valuation gauntlet. We're going to tear apart the financials of this hospitality software developer using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then stress test it against modern discounted cash flow and multiple-based models. What's the goal? To figure out exactly what this thing is actually worth. But before we get into the heavy lifting with our models, we've got to anchor ourselves in reality. Right now, Agilysys is trading exactly here, $90.14. Keep that $90 baseline in your head as we go through each guru's framework, because every single intrinsic value we calculate today is going to be measured straight against this current market price. Here's the roadmap for our gauntlet today. We'll start with a company snapshot. Look through the Buffett lens, the Lynch lens, and the Graham lens. Run a DCF valuation, and finally wrap up with our synthesis and final recommendation. Let's get to it. Section 1, Company Snapshot. Let's look at their fiscal 2026 core fundamentals to see what we're working with. So what did this company actually deliver in a record-breaking fiscal 2026? Well, these rapid-fire metrics show a business successfully nailing its transition to a highly profitable software-as-a-service model. Total revenue hit $319.3 million. That's a solid 15.9% growth. Free cash flow, a massive $68.1 million. And their GAAP earnings per share shot up from 82 cents to $1.37. Plus, their balance sheet is practically flawless with nearly $117 million in cash. But we do have to watch out for their massive new Marriott contract. Management noted that this property management system rollout is going to take at least 2 years, which definitely introduces some major timing risk for recognizing that revenue. Moving on to Section 2, the Warren Buffett lens, focusing on economic moats and owner earnings. Look at the divergence on this slide. It's wild. Standard GAAP net income sits at $38.8 million. But if we take their robust $68.1 million in free cash flow, we can actually use that as a proxy for Buffett's concept of owner earnings. That is serious cash generation, drastically outpacing standard accounting profits. And you know Buffett absolutely loves to see that. It's the true cash the business throws off for its owners. Let's run his checklist. Economic moat? Pass. They built incredibly high switching costs with their unified AI ecosystem. Once a hotel installs it, they rarely ever leave. Earnings consistency and high return on equity? Pass. We're looking at 17 consecutive record revenue quarters here. Manageable debt? Pass with flying colors. That flawless balance sheet and cash pile are completely bulletproof. But margin of safety? Yeah, that's a fail. At $90 a share and a sky-high valuation multiple, Buffett would demand a much bigger discount. He'd probably hold off until the price dropped to around $75 just to build in that safety net. All right, Section 3, the Peter Lynch lens, where we dive into categorization and the PEG ratio. First up, we have to put them in a bucket. Given their subscription revenue exploded by over 30% this year, and they're actively expanding margins as they scale their SaaS platform, we've got to categorize Agilysys as a classic fast grower in the Lynch playbook. Now, the make-or-break metric for a fast grower is the PEG ratio. If we take their hefty PE ratio of 65.3 and divide it by that phenomenal 30.2% subscription growth rate, we get 2.16. Honestly, that's just too expensive for Lynch. He strictly prefers a PEG under 1.0 to make sure he's not overpaying for future growth. So even though he'd absolutely praise their balance sheet, and we'd ideally want to see strong insider buying to confirm his thesis, the valuation alone is a deal breaker here. He'd probably wait for a pullback to around $65 to get that PEG ratio in check. Next up, Section 4, the Benjamin Graham lens, focusing on the defensive investor checklist. This is where the stock faces its toughest hurdle. Running down Graham's checklist is basically watching a clash of investment eras. Modern tech companies like Agilysys reinvest all their cash into growth instead of paying dividends, right? So while they easily pass on adequate size, strong financial condition, and earning stability, they completely fail Graham's dividend requirement and his strict rule for a PE ratio under 15. I mean, Graham would probably pass out looking at a 65 PE multiple. And this perfectly highlights the limits of asset-based valuations for software companies. If we plug their numbers into Graham's intrinsic value formula, taking the square root of 22.5, multiplying it by their EPS of $1.37, and then multiplying that by an estimated industry average book value per share, since we had to fill that data gap, the result is drastically below the $90 stock price. Bottom line, Graham wouldn't touch this. It simply doesn't fit the profile of a classic asset-heavy value play. Which brings us to Section 5, DCF valuation. where we are projecting future free cash flows. Because Graham's model breaks down here, we need a modern, discounted cash flow model to really value this company's future cash-generating power. We're explicitly stating our assumptions here to keep it rigorous. First, we forecast free cash flows with an aggressive but historically supported 20% near-term growth rate, driven by those booming subscriptions. Second, we calculate the terminal value assuming a steady 3% perpetual growth rate. And finally, we discount those future cash flows back to today's dollars using a standard 10% weighted average cost of capital, which is super appropriate for a profitable tech stock. When we run those numbers through a sensitivity matrix, look at what happens. Right there in the middle, with our base 10% WACC and 3% terminal growth, the fair value lands right around $92 a share. What does that mean? It means the market is pricing Agilysys almost perfectly efficiently right now, based purely on its future cash flow potential. Moving to Section 6, Other Valuation Models, let's look at multiples and analyst consensus. The massive valuation risk jumps right off the screen here. Agilysys is trading at a PE of 65.3. That is more than double the U.S. software industry average of 28.2. Yet Wall Street analysts have an average consensus target of around $126, and Simply Wall Street's narrative suggests it could be worth up to $138. Why the massive premium? Because the market is heavily pricing in their successful transition to high-margin recurring revenue and their shiny new AI innovations. Finally, Section 7, Synthesis and Final Recommendation. Let's see who survives the gauntlet. Stacking these frameworks side by side reveals a huge divergence. The optimistic market narratives and Wall Street analysts see massive upside, pointing to targets of $126 to $138. Our baseline DCF model says, hey, it's basically fairly valued today at $92. But our strict fundamental heavyweights, Buffett, Lynch, and Graham, they demand a much lower entry point, emphasizing that there is literally zero margin of safety at these high multiples. So, bringing it all together, our final verdict is a hold. It is a completely phenomenal underlying business. The balance sheet is flawless, the momentum is incredible, but the current price leaves absolutely no room for execution errors, like delays in that Marriott rollout. If you want to follow the gurus, you've got to set your target buy triggers lower, around $75 for a Buffett-style margin of safety, or $65 to satisfy Peter Lynch's PEG requirements. So I leave you with this final question to ponder. Is the massive premium for their new AI-native modules truly justified by actual future cash flows, or is the market already priced in absolute perfection? Keep digging, keep analyzing, and we'll catch you in the next explainer.